Hey, following our series on money in your 50s, 60s and 70s.
That was a fun one.
It was good. There was a question on the YouTube from STJ Emrad. What about extra non-concessional contributions versus paying down the primary place of residence or investment property mortgage? Now, before we get into that question, Martin, there was some chatter in the Facebook group probably a few weeks ago, if you're listening to this, when that episode first dropped, about, because we talked about if you're at a certain age, mid-50s or whatever, there could be a benefit of minimum mortgage repayments, pumping super.
Yep, for the
then
tax benefits.
when we retire, and then there was some chatter in there about the feeling of peace and security by just attacking a mortgage. And that's totally fine because it's a tax strategy, the pumping super and withdrawing when you are, at, an age to get
50s,
that.
early 60s. Yeah, and that's where personal financial advice is personal. There's no right or wrong answer with this, and that episode and episodes like these are food for thought for some people. I go, I understand I can save $5,000 a year in tax, but
But at what cost?
My sleep at night factor
Yes.
is not worth that. Whereas other people go, I want to pay the legal amount, but the minimum amount of tax as possible. Explain all the options to me. And I'm okay knowing that, yes, my mortgage might be $50,000 higher, but my super is $100,000 higher. And I know there's a door at 60 that I can open to start to pull that out. There's no right or wrong answer there. And that's kind of where that foundation was. And this question's kind of jumped in on the back of that.
Can I also potentially add as a bit of a challenge, because I will confess I'm not in my mid to late 50s. I might look like it, Martin.
Are you in your 70s or?
Yeah, knocking on 70's door. What about some type of compromise and some hedging of risk? Because there was chatter, people legitimately being made redundant, losing employment in their 50s. It happens.
Yeah.
There's people in their 20s and 30s that get made redundant and 40s, but it can feel a bit harder as we get older for whatever reason to try and, get back in the workforce.
Yeah.
May I suggest if you are in that 50s age and you're like, oh, I really like the idea of paying down the mortgage for that security as opposed to optimizing my tax savings, we talk about having an emergency fund. I'm okay if you say, look, we want to build a $100,000 emergency fund or a year's worth of income. Usually we say 3 to 6 months. But if you want to say, look, at all times, we want to have $100,000 in an offset or redraw or insert your thing here. So if you do get made redundant, there's 12 months of buffer there that can, cause you less anxiety.
Yeah, definitely.
So that's an option as well. To just keep cash heavy first, we're going to save 80, 100, 50, whatever your number is, higher than what the textbook 3-month emergency fund is. Then once we do that, we're going to start the tax strategy.
Do 50-50 the tax strategy. So
yeah, you don't have. Yeah, it's not all or nothing.
It's not all or nothing. And even at that point, it's around, okay, well, many people might have their mortgage paid off by 60, but many might not. And so then it's around, okay, well, does it really matter if it's paid off in 62 versus 64? Knowing that at 60 I can maybe use some of my super to pay that off. And I think that's the other part that hopefully people took away from that is that we didn't even know that was on a table on the option, option on the table to at least explore. So,
okay, so having all that, said all that, the question again, what about extra non-concessional contributions versus paying down the house or investment property mortgage? Is it fair to say because the investment property mortgage is tax deductible, it's last on the chopping block?
Yeah, I think also based on what we just said, I think these questions come from on the basis I have maximised my concessionals.
Yeah.
So I think that's what I'm saying. Thanks for that. But what about extra non-concessional? So I think they're kind of saying, let's say I'm happy with that strategy that was discussed on the podcast. I'm going to maximise my concessionals. We know there's certain limits. You can only do $30,000 a year, including your work contributions. So that might only be $10,000 a year. So now you've got an extra $20,000 a year on top of that. Where does that go to next? And so the three options is, do I pay down my home loan debt, or do I pay down my investment property debt, or do I put extra into super voluntarily? again, personal preference, and we can run projections to show you which one or the other. But for me, the hierarchy typically would be, if we're looking at the two debt options, yeah, you've summarized it well. Well, my home loan debt, my bad debt, is going to come well before the investment property debt. And I would say that's going to come number one after your concessionals. Number one, concessionals. Number two, pay off your bad debt.
If we are, like, if someone is in a position to be fortunate enough to cap out the concessional cons and do this tax strategy, because effectively that's what it is. We're not putting extra on the mortgage. We're going to cap out our concessional cons.
Into super, yep.
We might then use some carry forwards, catch up the last 5 years if there's any holes. The question then with the non-concessional contributions, it's not a year on year, and please correct me if I'm wrong, Martin, because I'm just trying to learn like everyone else. The question is, well, it's not a year on year tax strategy, it's a future wealth creation strategy, and I want my money growing in a tax advantageous environment. Is that a fair statement?
I think that's fair. Yeah, I think that's fair. And return on investment.
Yeah.
So looking at that, let's say I've got 10 grand surplus after I've done everything else. If I pay my home loan off, I'm going to save myself 6% in today's market. But that's an after-tax 6%. So before tax, I'm actually getting a decent return as a guaranteed return. It's not growing, but it's saving me interest against my home loan. Question two is, if I pay it off my investment loan at, say, 6% as well, my 6% on my investment loan is a tax deduction. So the 6% is not actually really 6%. I can claim it back on my tax. So it's probably effectively a lower rate of return versus if I put that $10,000 into super as a non-concessional, no tax when it goes in, but now it's invested in my super, what return am I going to get on that versus what potentially the interest I would have saved elsewhere?
Question, and this is circumstantial, like if someone had I'll make some numbers up. Someone was 55 years old. They had an extra $30K a year after tax, after capping out the $30K concessional
Concessionals and, yep.
If they were in a fortunate enough position just to have $100,000 left on the mortgage, you might take the view, stuff this, we're just going to pump the mortgage the next 3 years, that's done.
That's done.
Then we'll attack super.
I would think so, yeah.
Like, you can do whatever you want, but it is a difference there of everyone's individual circumstances.
Yeah, and I think looking at it through a perspective of, financial advisor can run these numbers for you. You can put into a spreadsheet what return is this getting me versus that. And the benefit of the mortgage is that it's a guaranteed return. Doesn't matter what the share markets or your super fund does. If you pay that off your mortgage, you're saving that interest. There's a buying power of inflation that maybe the spending power is less, but it's not going to change in volatility. It's not going to be higher. It's also not going to be lower.
And I think it's important to be loud and clear. Paying off the mortgage is a really good financial achievement.
Yeah.
And there's something out there in society about maybe keeping the mortgage. And we talked about in the 50s episode and now it's like, as a tax strategy, it might be better over the next 10 years to pay minimum and do the rest. But an example of this, I talked to somebody last week in their 30s. They were a small business owner and she's got a mortgage of, I think she said $500,000. She sold one business, bought another one. The business sale proceeds after tax, she's getting about $750. And, there's on the new business, there is tax deductible debt, which is awesome. And she was asking me, like, what should I do with this money? And I'm like, for me, and this is just my personal thing, there's no way on the planet I would not be clearing my mortgage and be debt-free. And if you want to go ahead and buy an investment property one day or buy shares one day, you can borrow against it in a tax-deductible manner. But she just had this in her head that paying off the mortgage might not be a good
it's
thing.
too boring, but boring is
Yeah.
sexy. Boring is
Yeah.
important. And yeah, you're right. In our 50s, we're talking about super. I'm thinking the episode about in the 60s was like, have a plan to be debt free. So 100%, we want to be debt free against our home loan at some point. One way or another, whether that's using super, whether it's selling an investment property, and that might be I don't think there's a clear answer here of should I do non-concessionals, should I pay off my investment property? The way I would answer that with the client if I was talking to them was reverse engineering. Where are we going to be in 5 or 10 years, and how is this investment property playing into the scenario? If it's a case of this investment property, my family's living in, I'm going to need to keep it for the next 20 years, well, we need that to be debt-free, or we want to head towards being being debt-free. So that might be the focus of paying down the investment property after your own home loan's paid off. If it's the opposite of, when I get to 63, we're going to sell that property, it's been a headache, there's a capital gain, we're not going to sell it now, I perhaps wouldn't focus on paying down the debt, because the debt being higher is tax deductible while I'm working. And if we pay it down too much and sell it and get too much equity, we might not be able to get that into super at the time. So rather than having using an extreme figure, an investment property of $1 million paid off completely, I sell that at 63, I can't put all that into super. If I had done the opposite of pumping into super earlier, some non-concessionals, and there's still, say, $400,000 of debt on that investment property when I sell it for $1 million, clear the remaining debt, that's $600 left over between me and a partner or a spouse, I can get that into super. So I think that's the non-concessional versus paying an investment property comes back to what's the exit strategy or what's the end game for the investment property, I think dictates that decision.
Yeah, yeah. And potentially, what do you, like, we don't know this person's age. What's their age? What's the plan for the PPOR? Mm-hmm. Are you happy to live there in the next 20, 30 years? Or are you like, yeah, we're pretty much going to get rid of it? Still, it's okay to still pay the debt down, but
we know that's going to be an exit. Or I've had a few clients recently, that investment property is going to be our retirement home. Well, then we do want that paid off.
Yeah.
Or vice versa. If that's going to be paid off, it's a holiday home worth $800,000, a house we're living is worth $2 million, we're probably going to sell the $2 million and move into the $800,000. Well, that $2 million is going to have to go somewhere. That's going to clear a fair bit of debt or go into super at some time.
For those that have multiple investment properties, and because I was thinking about this for myself the other day, like at all times, the properties that I've got, I know the one that's on the chopping block first if I need to sell it. Mm-hmm. And that's the question as part of your strategy. Like, which is the ugly duckling that you're going to sacrifice and rather, I don't know, because it's such a big transaction.
Yeah.
And I'm not saying the one that's my ugly duckling hasn't performed well and all that, but it's the one I don't like the most for a few reasons.
Yeah.
And I'm even thinking I probably will get rid of it in the next 10 years.
Yeah.
And not hold forever.
And I think, not quite in this question, but that raises something that there's a few clients that come to mind I've helped in the last year or two around that. And actually, one of them referred was from Rach, from the mortgage broker, from the property podcast.
Yeah, so we do a podcast called This Is Property. It's also on YouTube and on podcasts.
And so she had a client she was working with that had multiple properties and had multiple loans and wanted to purchase more but had a bit of a banking cash flow issue. There was plenty of equity there, but just the rent coming in, the mortgage payments going out didn't quite stack up. So it needed a bit of an overall plan and a strategy. And round figures, might have had $6 million of investment properties and $2 and a bit million of debt. So plenty of assets there, but cash flow was really poor for different reasons.
And what, she didn't want to sacrifice one on the altar of life?
Don't we just keep them all forever? Isn't that the only way to achieve retirement? And sitting down in their late 50s going, I don't think you're going to pay off that $2 million of debt in the next few years just from cash flow. We're going to have to liquidate one or another. And so it's now been 2 years and ignoring their wages, the properties 2 years ago, there wasn't much left over at the bottom. We caught up a couple of weeks ago. Those properties now, I think there's worth $5 million of property and $600,000 left of debt. They're now pumping up $100,000 a year of cash flow after the mortgage repayments are sorted.
Is it all resi or some commercial?
Mainly resi.
Wow.
But just by liquidating a couple, some were on P&I because they'd been in place for so long. Some were just under market rents and needed to make a bit of adjustment. And we did a refinance as well that helped. But So net asset position, still very similar, 4 million give or take, but cash flow position very different with a bit of a strategy in place.
I would say as part of this strategy as well, it might be an argument to switch your investment property debt to interest only if it is on a principal and interest.
Yep.
Like if you had lived there and you just moved out because you'd want to divert that extra
Surplus
principal
cash flow.
repayments
Yep.
to your principal place of residence.
Yep.
We'll be back right after this. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.